Knowing when you can retire is a question we get asked all the time, and it can be hard to say exactly when. If you plan on retiring earlier or you have income that starts at different times, such as the state pension or any defined benefit pensions. In this video, we're going to look at how much income you might be able to take from a £500,000 pension from both flexi access drawdown and also an annuity. It's important to watch to the end though, as I'm going to cover several retirement ages, including a scenario that looks at someone who perhaps retires at 55 and 60 and the impact taking more income from a pension fund can have if you plan on perhaps bridging the gap before other income kicks in at a later date, such as the state pension. Turning to drawdown, let's see what income you might be able to take if you opt for a flexible income. One way to do this is to carry out a cash flow forecast, but this software is very expensive, and if you aren't a financial planner or using a financial planner, this might not be possible for you. But before you switch off, a simple approach to give you a rough and ready idea is to calculate what income you can take each year that would extinguish the drawdown pot at a certain age. To make this realistic, one option is to set it so that the pot is extinguished at a realistic and conservative age for life expectancy. Okay, so let's make a few assumptions with that in mind, and we'll use our example based on Duncan, and we'll assume he lives until age 92, and we'll set it so that the drawdown fund pays out the same amount each and every year so that the pot is extinguished at this age. I know, the whole point of drawdown is the flexibility and the ability to change your income from year to year, and virtually nobody is going to take the same amount of drawdown income each and every year. But I think for the purposes of just looking at the sustainability of the income, this is one of the best methods. For somebody who retires at 55 and 60 and plans on taking significantly more from their drawdown pensions before the state pension kicks in, this method isn't really appropriate. So for those scenarios, we're going to turn to our cash flow planning tool to see what the effect of taking more income earlier in your retirement can have. However, let's start with Duncan, who retires at age 66, and work our way backwards. So if Duncan retires at 66, the same age as when he's eligible for a state pension, and his expected life expectancy is age 92, this is a retirement term of 26 years. As this is the shortest time in retirement of all of the examples, this means he can take the most amount of income. And just to hammer home the point, with this simple rough and ready example, for age 66 only, we're working out how much income he can take from age 66 each and every year that increases by inflation, that will extinguish the pot at age 92. Okay, so Duncan could potentially take a starting income of £26,208 that increases with inflation for the pot to be completely extinguished at age 92. By age 74, the pension would still be worth over 450 grand that his beneficiaries could potentially inherit if he croaked it, tax-free. If we assume Big Dunk was entitled to the full state pension of £11,500 a year, this is a retirement income combined of more than £37,700 without even accounting for a spouse or partner's retirement income. Even if we look at the Retirement Living Standard Survey, which many of you often comment that the figures they quote for a decent retirement are way inflated, even if we work with these numbers just for argument's sake, this would give Duncan a very comfortable retirement. So the example of retiring at 66, the issue with that, virtually nobody is going to take the exact same amount of income each and every year. So what we're going to do in this scenario for 60 and 55 is assume somebody takes a higher income from either 60 or 55 through to 80, at which point they drop their expenses by 25%. Maybe they're no longer going on holiday or doing the things they used to do during their active years of their retirement. So quickly, let's talk about the input. So we forecast Duncan, he dies at age 92. I'm going to set it so that the pension extinguishes at that age. Here you can see the only pensions he's got is his defined contribution pension worth 500k at growth rate 5%, we'll call it, and his state pension, which will kick in at age 67 for the full amount. What we've done in this scenario, this red suggests he's running out of money, and what I've just done to highlight this is shown him taking 5k a month, which is 60k a year, or 12% of the initial pension fund, and the effect that can have. Unsurprisingly, that's 12% of the pension fund. That's a significant unsustainable amount, and as you can see with what this red suggests, he's running out of money at this point. Not surprisingly, 12%, just not sustainable. Okay, so what I've done is I've looked at an example earlier and calculated what income he can take from age 60 through to age 80, at which point it then reduces it by 25%. What kind of expenditure can he take? Okay, so let's have a look. We can see here there's no red, which is nice, means he's not running out of money. So let's turn to his expenses that we put in. So he can just take over a little over £2,500 a month from 60 through to 80, which rises with inflation, and then from age 80 that reduces by 25% down to just over £1,900 per month. Using these assumptions, all else being equal, you shouldn't be running out of money, which is great. Obviously, we can't guarantee 5% growth rate. That will have a big determinant on the success of his retirement. If returns are more, great, he can potentially take more income. What I like to highlight though is something called the sequence of returns risk, and I have done a video on this which you can see on the screen now. But this is the idea that the timing of investment returns matter a huge deal. If for example, you retire on the eve of a stock market crash, this can have a much more negative impact than someone who perhaps enjoys stellar investment returns when they retire. This is because not only are they now taking an income from their portfolio, but they're taking an income from the falling value. So what we've done is we've stress tested this against the banking crisis type of event from 2007 to 2009, and you can see this with the growth rates on the screen there. So first year 6.5%, it grows by great. Second year falls by 4.5%, and then we have this dramatic fall of nearly 35%. In this kind of a scenario, using the exact same assumptions, £500,000 pot again, he'd be running out of money at around 73, 74 or so. So what we can do, what I've done before, is reverse engineer this and say, if he carries on taking the same amount of income that he did, how much would he need to not run out of money? Okay, so he would need a pension, and we worked this out earlier, of just over £820,000 to ensure that he doesn't run out of money during his lifetime, which is quite a frightening figure and a great deal more, and it just does show you that there's a lot involved in the success of your retirement. How about if Duncan retires at 55? That's 5 years early. It's going to put more of a strain on the pension fund, and he's perhaps going to have to take less income as a result. So what I've done in this scenario is exact same assumptions, lives till 92, same growth rate of 5%, state pension there, but what I've assumed just for this example is that he takes 40k a year, £3,333 per month. Quite a significant amount, that's around 8%, which is, funnily enough, similar to what the FCA study found with the average retiree taking in drawdown. What kind of effect does this have on the pension fund? So if he retires at 55, takes 40k a year, 8%, he'd be running out of money at age 69, which is quite scary, as that's relatively young and still during his active years of his retirement, you'd argue. Okay, so not surprisingly, 8% is an unsustainable amount. What income can he take then to ensure he doesn't run out of money? So we've made this example earlier, and great, we can see there's no red right through to the end of his life expectancy. In this scenario, he'd be able to take a little over £2,200 per month from that active years of his retirement, 55 through to age 80, at which point it then reduces by 25% to a little over £1,600 per month. And in that scenario, he shouldn't be running out of money. Another popular and simple option is to use an arbitrary rule of thumb, such as the 4% rule. This involves taking 4% of the starting pension amount each year and adjusting it upwards by inflation. However, you'll see many commentators on a quick Google search suggesting 3% is more appropriate, whereas others would say that you'll be fine with a high withdrawal rate closer to 5%. You can see what the potential income could be depending on what withdrawal rate you go for. The issues with this, though, are it doesn't really fit the scenario of someone who plans on taking more income to spend maybe on holidays or during their active years of retirement and then dropping it when maybe their state pension kicks in. And there's no guarantee that the 4% rule or any other variation doesn't mean you won't run out of money. Perhaps investment returns are worse than expected, or stock market crashes, investment crashes are much more pronounced in the future. For annuities, we're going to focus on lifetime annuities. With an annuity, you essentially swap your pension fund in return for a guaranteed income. Once you die, the annuity usually dies with you. It is possible though to add inflation protection and also a survivor's pension so that the income, one, maintains its purchasing power and two, can provide a pension for your loved one if you die. Now these frills though, however, they do reduce the starting income, as we'll show you in a minute. As the income is guaranteed, unlike drawdown, there's no risk of the pension or income running out. Annuities fell out of favour after the pension freedoms were introduced in 2015, along with the ultra low interest rate environment that existed right up until 2021 after COVID. However, you can see a graph on the screen now which shows how the potential income from annuities has risen dramatically as interest rates rose very sharply in recent years to combat inflation. The amount of annuity you get will depend on many factors such as how old you are. The older you are, the better the rate tends to be, as the insurance company statistically works out that they'll have to pay you the income for a shorter period of time. Your health's important. If you've got any health conditions, you may be entitled to an impaired annuity, which can translate to a higher annuity rate. If you add any inflation protection or survivor's pension, this will usually reduce the starting income. Finally, the annuity rates will be different from insurance company to insurance company as they compete for your business. To show you the effects that the options that you add onto your annuity, we're going to look at two different ones. So the first annuity increases by inflation, has a survivor's pension that will reduce to half on the annuitant's death, and has a 5-year guaranteed built in so that, come what may, the annuity will pay the full amount for the first 5 years, even if you died in year 2, for example. The second annuity, we're going to base this on a single life basis. It doesn't increase with inflation and there's no guarantee period. So you can see on the screen now how the extra guarantees and frills with option 2 can significantly reduce the starting income, but at the same breath, you'll be pretty sick if you opted for an annuity with no inflation protection at the beginning of 2020 when inflation subsequently rose dramatically and your annuity income was cut in real terms. Equally, your loved ones would be pretty disheartened if you opted for an annuity with no survivor's pension and you died prematurely. The reality is there's no right or wrong answer. It's going to depend on your individual circumstances and making a judgment call to some degree. Knowing how much income you can take from your pension is really important, but if you are considering drawdown, watch this video which looks at how you might be able to potentially increase the tax-free cash from your pension.